Okay, so this is quiz 3, and we gradually move into talking about activity-based costing. And what we have here is a scenario. I will just snippet this out very quickly. We have an activity-based costing um, scenario where we are trying to find what the rate of the cost driver is. Um, so it says here that we have a payroll provider decided to use activity-based costing. It has 5 customers with the following monthly staff. The total cost is 13,000. So if we're going to be using the monthly, um, the number of people, if you like, as the drivers, as the cost driver, we need to, well, add all of them together. So when you add all these figures together, you get 2,600. Yes, yeah, sorry. Yeah, so you get 2,600. So you now have 13,000 over 2,600, which is equal to £5. So you know that you will assign a figure of 5 for every member of staff. So literally just multiplying each of these by 5 would mean that you would be able to apportion this figure of 13,000 between the different departments. So your answer is 5. Let's carry on with question 2. And in question 2, I've tried to create a snippet so you can understand what's happening here. We're given information, and then what they do is to tell us that, listen, we want to start using activity-based costing, and we want to do better with our overheads. So in effect, what we currently have is a measure using traditional absorption costing. Like, we don't want to use this anymore. Let's use activity-based costing. And we're given some data. Right. So it's telling us that, listen, with this labor overhead, this is how it works. You have processing, 22,000. You have A and B. Then you have quality control, 8,000. You have A and B. And then you have packaging, you have 10,000. And then you have A and B. I'm just going to change my pen color. And how do we split that? It tells us, if you come here, it tells you that 70% of the processing goes to A. So let's just come back here. So 70% of this processing cost comes to A. So I will do 0.7 times 22,000. So that's 15,400 to A. And of course, the rest will go to B, 6,600. And then it goes on to tell us that 80% of quality control goes to A. So 80% of this is 6,400, and this means there's 1,600 here to B, and here I believe it's 62%, so 6,200 to A, and therefore 3,800 to B. So we now know what the total labor, this is a better way of splitting it. So this is the total labor to A, this is the total labor to B. And so we can just add that up in totals. So we have 15,400 plus 6,400 plus 6,200. So we have 28,000 to A. And then on this side, we have 6,600 plus 1,600 plus 3,800. And that's 12,000 to B. Right. Now we know that you have 1,000 units of A and 500 units of B. So now I can share, if you like, these costs by their units. I'm actually interested in B, I believe this question is. So therefore, splitting this overhead over the costs in B would be 120 divided by 5, and that's 24. So the better version here is 24. So given that you have direct cost of 30, overheads of 20, then you have 24, and you have income of 80, this means that the new profit figure will be a profit figure of £6. Yes, profit figure of £6 because this has increased. And I think that's what this question was actually asking for. What would the profit or loss be based on that? And you have a profit of £6. And it'll be this. Okay. A theory question. Which of the following about incremental budgeting is not true? So this is true. We take the prior year, the previous year, and use that as a base to build. So this is true. actually, because I think I'd built a, yeah, so this is true. Right? Oops. Oh, I thought I had, yeah, so this is true. In setting the budgets, we amend by adding and removing, adjusting for inflation. Yeah, this is very true. Now, I think there's an error in the question when I say the actual exam, because these two are exactly the same thing. They read exactly the same. Don't it is this is not true because it is used in the public sector. We use a lot of outturn budgeting and contingency. So 3 and 4 were supposed to be your answers as being not true. Yeah. So that's the what is not true. What is not true is both 3 and 4. This is not true. Yes, this is not true. These are both the same thing. They're reading exactly the same way. Okay. This is all theory. What budgets are updated in relation to new information? So as we get new information, right, we have what we refer to the rolling budget as the budget that helps us with updating information. Incremental was what we just did. You have the base and you add for you deal with it by adding inflation and changes. But with the rolling budget, we're very aware that maybe at the end of every 3 months, we look at the variance analysis and we adjust, right? There's no such thing, there's no technical term for constantly updated budgets. This is not a technical term. And planning and programming budgeting system is about the system itself, right? In terms of looking at the future and the holistic, the rounded nature of budgeting. But the idea of regularly, maybe every quarter or every 6 months or every year, assessing um, the budget for changes, it's a rolling budget. Let's carry on. So what we have here is we're trying to find the profit or loss for March. So the important thing is to sort of let's put some things together. So we have sales, and if you like, we have cost of sales. So sales, we're told that we sell 180 units. So we're selling 180 units, and we're selling these units at £40 a unit, and that's 7,200. Not a problem. So cost of sales, of course, will also be for 180, but this will be made up of 1 second. The point is, sorry, I was interrupted there. Was that the point there was that what we need to do is to of course recognize what cost of sales is. So you're starting off with 10 years. Well, it's all at the same thing in terms of it's all at the whatever your full standard cost is. So 5 plus 8 plus 3 plus 4, right? Because that's the full cost. 5 plus 8 plus 3 plus 4. We will be careful about this. We'll come to talk about that. So that's equal to 20, right? So it's really 10 times 20, which is your opening inventory, plus your production, because you produce 175 times 20, minus your closing inventory, which would be 5 times 20. So it's the same sort of approach. Where is my calculator? So really it's 180 times 20, isn't it? Really 180 times 20, which is 3,600. There is a slight issue. Remember that you're putting in £4 for every unit you produce. That's how these production overheads work, right? So you have put in 175 units, and therefore you've produced 175. So for every unit that you produce, you put in an overhead of £4. So you've put in 700 so far, but you are told that the fixed overhead production is actually 800. It means you've not put in enough. So you need to put in another £100 due to the under absorption. That's what's really happening here. Yeah. So you need to put in an extra 100 because overhead production or overhead figures work by putting in these amounts based on the number of units, and you produced 175, therefore you've put in 4 times that because that's based on that. This 4 is in here. Then you also have these fixed selling costs of 1,000, and we will deduct that. And we're also told that we have variable selling costs of 15% of sales. So 15% of 7,200 is 1,080. So we also have costs of We also have costs of 1080. So what do we now have in total? We have 7,200, take away 3,600, take away 100, take away 1,000, take away 1,080. Do all this and you get 1420 as your profit. 1420 as your profit. Great stuff. So the next question says that you have a situation where this company manufactures bicycles, selling price is 135 and the variable cost is 85. So we can find the contribution per bike. So we 50, and so we have a contribution of £50 per bicycle, right? And it says that during September the company produced 240 bicycles. So there were 20 bicycles at the start of the month. They produced another 240, and at the end of the month they had 10. So it means that they actually sold 250 bicycles. So if they sold 250 bicycles, the question here is what is the contribution for that number of bicycles? And that's, of course, the 50 times 250. 50 times the 250, and that you have is the 12,500. Yes, the 12,500. And that's the answer for that. That's the answer for that. One more thing, of course, we ignore fixed costs when we're talking about contribution. Yes, our focus is on the selling price minus the variable costs. That's how this works. Good stuff. Let's use marginal costing, the marginal costing methodology first. Marginal costing. And if we use this method first, what we're really saying is, okay, listen, here is the unit selling price and the unit variable cost. So that's what we're dealing with first. So in a way, you could almost, because that's all we're really assessing first. I mean, really. And so you have here £35 as your contribution. Now you sold 95 units, and therefore your revenue, if you really want to think about it, if you like, because you see, really what we could say here is that yeah, because that's what you sold, really. Whether we say that your cost is you produced 110 at 55, and we deduct the 15 that you didn't sell at 55, you're still going to get the 90 units at 55, right? Because that's the number of units, that's the cost of what you sell. But you sell those 90 units at 90. So it's the same discussion, really. It's still the same thing at 90. It's still the same sort of, 95. 95 units is still about the 95. So ultimately, it's still the same 95 units at £35. So whether you did it individually up here or you decided to do it like this, where you're dealing with, because there's no opening inventory, you see. So it's just your production less your closing inventory. That's why you have a sale of 95 units. So what do you have? You have 95 times 35, which is 3,325. Now you have to take off, you have this fixed cost. Remember that with marginal costing, we don't absorb any of the fixed costs. So take away the fixed costs, and then also take away the non-manufacturing costs as well, because these are just coming off their period costs. So that minus 2,000 minus 1,200 leaves you with a marginal costing profit of 125. So actually, for the purposes of the exam, we know this is the answer here. For the absorption costing, I'll just clean this off so we can just have some space so we can talk about this for the absorption costing, what we would be saying would be, right, let us look at this. So we would argue that, look, we have a case of we're selling for £90, and yes, we sold 95 units, not a problem. But then the cost of our stock is fully absorbed. We absorb the fixed costs, and it says the non-production level is 100 units. So you will assume to absorb a fixed cost of £20 into the stock, as according with the standard IAS2. So the full cost of a stock would be 55 plus 20, which would be 75, right? Because we're absorbing this cost. So what would have happened was you would have produced 110 units at 75, and you would deduct what you did sell as closing inventory at 75, right? So this would be your cost of sales, if you like, 95. You sold 95 units, 95 units at £90. So your cost of sales would be 95 units. Sorry, yes, 95 units at £75. 95 units at £75. So let's just quickly do that. So we have 90 times 95. So here, this here is 8550. Then you also have 95 times 75. And here you have 7125. So you have 8550 minus 7125, which is 1425. That's the first thing, right? Now, there is a slight issue, because when you did this, the idea was that you were going to absorb this 2,000 over 100 units. So you're assuming £20 is what your fixed cost would be, because you're going to make 100 units. But you made 110 units with fixed costs of 2,000. So you have absorbed an extra £20 on these extra 10 units. So you have an extra cost in here. So you have this £20 times 10, which is 200. So you have put through an additional 200 that shouldn't be there, because you're absorbing for every unit you produce, but the cost really is 200. So I need to, if you like, add back, well, reduce this. Well, this is my profit, isn't it? So I need to add back my 200 to this. I need to add 200 to that, because I put in too much. I had over absorbed. So add this there, and then take off the non-manufacturing costs of 1,200, and you will get here 425 as your profit. Yes. So that's really the point. The point here is that we have to deal with the over absorption because there's an additional cost. We need to kind of either reduce the costs or add it onto our profits, and we're there at the right answer. Okay, great stuff. And finally, this is really talking about whether or not the marginal costing methodology, or whether the marginal costing methodology or the absorption cost methodology gives us a higher profit. And it's really just to do with the movement of stock. Now, here's the thing: when you have a scenario where your sales is less than your production, what that means is that you have closing stock. right? So imagine you produce 150 units, but you only sell 100 units. With absorption costing, you will carry through to the next period um, stock of 50 units, right? So this 50 units in absorption costing will take some of the fixed costs from this period into the next period. That's the point, right? This when in this scenario, these 50 units will take some of this because they absorb some of these fixed costs so because of that, they remove some of those fixed costs from this period. And so because they remove some of those costs, the profits here are higher in absorption costing um, when you produce more than what you sell, right? So, but but you see, because with marginal costing, all the period costs happen in that period. But with absorption costing, you absorb the costs into the units, and they're going into the next period. But you see, that's the interesting thing because now in this period, when you now come to sell, because you're now selling 150. Imagine you're selling 150 units, but you only produced 100 because you produced 100 and you're bringing in 50 from the prior period. There is a higher cost here that's come through, right, with those absorbed costs from the previous period. So because you now have a higher cost here with absorption costing, because you're bringing in, you see, with marginal costing, you don't have that. With marginal costing, the stock is at variable and the period costs are the same for that year. But in absorption costing, you're bringing in those costs into this period. So because you have a higher cost with absorption costing, in the next period, you will have lower profits in the next period with absorption costing. You're just really shifting costs. So marginal costing will give you a higher profit when your level of sales is greater than your level of production, because when the idea of your level of sales being greater than level of production simply means that you're selling goods from the previous period that you didn't produce in that period, right? So in this period here, I'm selling 150 units. I've only produced 100, but the extra 50 have come from the previous period, and these 50 have absorbed costs from the previous period for absorption costing, but not for marginal costing, right? So naturally, that means that the um, situation would mean that your profits are higher for marginal costing. Cool, great stuff. And that is the end of that section quiz 3.